Silver just crashed 50% from its all-time high of $121, and now some analysts are saying it's heading to $175 by the end of this year. Are they completely insane, or do they know something the rest of us are missing? Monday, February 16th, 2026, New York time. Go ahead and comment your date below so I can see where you're watching from. If you value this work, subscribe and drop a comment saying George Williams. It really helps keep this channel going. Look, I've been covering precious metals for years, and I've never seen anything quite like what just happened to silver. Less than 3 weeks ago, on January 29th, silver hit an absolutely mind-blowing all-time high of $121.67 per ounce. People were losing their minds. Social media was flooded with silver bugs claiming vindication. And then, almost overnight, the bottom fell out. We're now sitting at around $77 to $79 per ounce, depending on when you're watching this. That's a 50% haircut in less than a month. Half the value, gone. Poof. So when I hear analysts throwing around price targets of $175 or higher for later this year, my first instinct is to roll my eyes. But here's the thing, and this is what makes markets so fascinating. Those same analysts aren't just making stuff up. They're looking at real data, real supply and demand fundamentals, and real macroeconomic trends that actually support their thesis. The question isn't whether they're crazy. The question is whether those fundamentals can overcome the absolute chaos we just witnessed. Let me paint you a picture of where we are right now. Despite this brutal crash, silver is still up 162% year over year. Think about that for a second. Even after losing half its value from the peak, silver has more than doubled in the past year. That's not normal. That's not a quiet, stable market doing its thing. That's a market that's fundamentally broken in some way, and the pressure is building whether prices are going up or down. The bulls, the people calling for 175 or higher, they're looking at something really important. For 6 straight years, the silver market has been in deficit. That means the world is consuming more silver than it's producing. This year, 2026, we're looking at another deficit of roughly 67 million ounces. Now, if you're not immersed in commodity markets, that might not sound like much, but here's the reality. When you have persistent deficits year after year, eventually something has to give. Either prices rise high enough to incentivize more production and reduce demand, or you run into physical shortages. There's no other option. And here's where it gets really interesting. A massive chunk of that demand isn't coming from investors or jewelry makers. It's coming from technology that isn't going away. Solar panels consumed over 25% of the entire global silver supply in 2024. Let that sink in. 1/4 of all the silver mined on planet Earth went into solar panels in a single year. And with governments around the world still pushing green energy mandates and subsidies, that demand is likely to stay strong or even grow. Then you've got electric vehicles. EV-related silver demand jumped 20% in 2025 because modern electric vehicles are absolutely loaded with silver. Every sensor, every high-voltage wire, every advanced electrical system needs silver because it's the best conductor we've got that's economically viable at scale. So the bulls look at this and say, okay, we've got structural deficits, we've got industrial demand that's not price sensitive because these manufacturers need the metal regardless of cost, and we've got a global economy that's shifting toward technologies that require more silver, not less. On top of that, they're looking at the macroeconomic picture. The Federal Reserve is expected to cut interest rates by roughly 60 basis points by the end of this year. Lower interest rates mean lower opportunity cost for holding non-yielding assets like precious metals. When Treasury yields fall, gold and silver become more attractive. It's that simple. There's also the geopolitical angle, and this is huge. U.S. Treasury Secretary Scott Bessent recently called what we saw in silver a classical speculative blow-off, and he specifically pointed to Chinese speculators as a major driver. Why does that matter? Because China isn't just speculating for fun. They're actively trying to reduce their exposure to U.S. dollars and U.S. Treasury bonds. They've been dumping treasuries and accumulating hard assets, including precious metals. The Shanghai Futures Exchange has been absolutely on fire, with volumes averaging 540 tons per day. That's not normal retail activity. That's institutional money, government-linked entities, and serious players positioning for a world where the dollar isn't the undisputed king. When you add all of this up, the structural deficit, the industrial demand growth, the accommodative monetary policy, the geopolitical shifts, you can start to see why someone might look at the current price of $77 and say, yeah, 175 isn't crazy. If those fundamentals play out and investor demand comes roaring back, especially physical demand for bars and coins, the math starts to work. Global exchange-traded product holdings are already sitting at 1.31 billion ounces. If just a fraction more of global wealth shifts into silver as a hedge against inflation or currency debasement, prices could absolutely explode higher. But, and this is a massive but, we can't ignore what just happened. Let's talk about the bear case, because if you're thinking about putting your hard-earned money into silver right now, you need to hear both sides. The crash we just witnessed wasn't some random, unpredictable black swan event. It was the result of excessive speculation, massive leverage, and a market structure that punished the over-leveraged when things turned. The Chicago Mercantile Exchange, the CME, raised margin requirements on silver from 11% to 15%. That might sound like a boring technical detail, but it's absolutely critical. When margin requirements go up, traders who are using leverage to amplify their bets suddenly need to post more cash as collateral. If they don't have it, they're forced to sell. And when everyone is forced to sell at the same time, you get a liquidation cascade. That's exactly what happened. Secretary Bessent wasn't wrong when he called it a speculative blow-off. Markets that are driven primarily by speculation rather than fundamentals are inherently unstable. They can go up way faster than anyone expects, and they can crash just as fast. The people calling for 175 need to explain how we avoid another speculative blow-off on the way up. If the rally is driven by the same kind of leveraged, momentum-chasing behavior that got us to 121, there's no reason to believe it won't crash again. There's also the substitution risk. I mentioned that industrial fabrication is projected to hit around 650 million ounces this year, but that's actually down 2% from prior expectations. Why? Because industries are getting smarter. Solar panel manufacturers, who are massive consumers of silver, are actively working on thrifting and substitution technologies. They're trying to use less silver per panel or find cheaper alternatives. If they succeed, and there's every reason to believe they will over time, that removes a key pillar of the bull thesis. The same goes for other industrial applications. When silver hit $121, every engineer in the world was tasked with figuring out how to use less of it. That doesn't reverse overnight. And let's be honest about sentiment. A lot of retail investors just got absolutely destroyed. They bought near the top, thinking this was the big one, the breakout that would take silver to the moon. And then they watched their portfolios get cut in half in a matter of days. Those people aren't coming back anytime soon. They're licking their wounds, posting angry comments on Reddit, and swearing off silver forever. You need fresh buying demand to push prices higher. And after a crash like this, that demand takes time to rebuild. So where does that leave us? What's actually going to happen over the next 3 to 6 months? Here's my honest assessment, and I want to be clear that nobody knows for sure. Markets are unpredictable, and anyone who tells you they have it figured out is either lying or delusional. But based on the data we have right now, I see 3 realistic scenarios. The first scenario is a choppy, sideways grind. Silver stays in a range between, let's say, $70 and $90 for the next few months as the market digests what just happened. The bulls and bears fight it out. Neither side gains a decisive advantage, and we just kind of oscillate. This is actually pretty likely in the near term because the Chinese Lunar New Year runs from February 16th to the 23rd, which typically reduces liquidity in Asian markets. Lower liquidity means lower volumes, and lower volumes mean less dramatic price movements. During this consolidation phase, we'd be watching for a few key indicators. Is physical demand for bars and coins holding up? Are ETF inflows turning positive again? Or are investors still pulling money out? What does the Fed actually do at their next meeting? If the economic data supports rate cuts and physical demand stays strong, that sets the stage for the next move higher. If not, we could drift lower. The second scenario is a resumption of the bull market, but at a slower, healthier pace. Maybe silver grinds its way back above 90, then 100, and by mid-year we're testing the old highs around 120. If that happens without the same kind of speculative frenzy, without the crazy leverage and momentum chasing, it could actually be more sustainable. The gold to silver ratio right now is sitting at about 63.4 to 1, meaning you need 63 ounces of silver to buy 1 ounce of gold. Historically, that ratio has gone much lower during precious metals bull markets, sometimes down to 40 or even 30 to 1. If gold continues to hold above $5,000 and the ratio compresses, you could see silver catch a serious bid without needing any new fundamental drivers. It's just reversion to the mean. The third scenario, and this is the one that keeps me up at night, is another leg down. If the Fed doesn't cut rates as much as expected, if Chinese buying dries up, if industrial demand disappoints, or if we get another wave of forced liquidations, Silver could test the low 70s or even the high 60s. That would be painful for anyone who bought at current levels, but it would also create what long-term investors call a gift. A market in structural deficit that crashes below $70 is probably a screaming buy for anyone with a 5 or 10-year time horizon. The question is whether you have the stomach to sit through the volatility. Now let's get to the big question. Can silver actually hit 175 this year? I'm going to be straight with you. It's possible, but it's not probable. For silver to more than double from current levels in less than 10 months, you'd need a perfect storm. You'd need the Fed to cut aggressively, inflation to stay elevated, the dollar to weaken significantly, industrial demand to exceed expectations, investment demand to surge, and probably some kind of geopolitical crisis or supply disruption to light a fire under the market. Could all of that happen? Sure. The world is unpredictable. But betting on it is speculation, not investing. What's more realistic is that silver ends the year somewhere between $100 and $130 if the bull market stays intact. That would represent solid gains from here without requiring everything to go perfectly. If you're thinking about putting money into silver right now, you need to ask yourself what you're trying to accomplish. Are you speculating on a moonshot to 175 because you heard some analyst on YouTube say it's going to happen? If so, be prepared to lose money. Markets don't care about your predictions or your hopes. Or are you investing in a hard asset with strong fundamentals that you believe will preserve and grow your wealth over the long term, even if the path is bumpy? If that's your goal, then silver at $77, with a 6-year deficit and growing industrial demand, starts to look interesting. Here's what I'd be watching if I were positioning in this market. First, physical premiums. If the premium you pay for a physical silver coin over the spot price starts rising, that tells you there's real demand and potential supply tightness. Second, ETF flows. When institutional money starts flowing back into silver ETFs, that's a sign that smart money thinks the bottom is in. Third, the dollar. A weaker dollar is rocket fuel for commodities priced in dollars. And fourth, China. If Shanghai trading volumes stay elevated and Chinese accumulation continues, that's a massive tailwind. If it drops off, that's a red flag. One more thing, and this is important. Don't put money into silver or any volatile asset that you can't afford to lose or that you'll need in the next year or two. This market just proved it can cut your holdings in half in a matter of weeks. If that would ruin you financially or emotionally, you're taking too much risk. But if you can handle the volatility and you believe in the long-term thesis, there are worse places to park some of your wealth. So here's my challenge to you. Drop a comment below with your prediction. Where do you think silver ends 2026? Are you in the 175 camp? Or do you think we're headed lower? And more importantly, what are you actually doing with your money based on that belief? If this analysis helped you think through the situation more clearly, hit that subscribe button and leave a comment saying George Williams. It genuinely helps the algorithm show this content to more people who need to see it. The silver market is one of the most fascinating and frustrating markets in the world right now, and we're living through a historic period. Let's navigate it together. I'll see you in the next one.